Hello and welcome. In this lecture video, I'll be talking about the allowance method. All right. So what we talked about with the direct write-off, remember with the direct write-off method, as soon as we found out that one of our customers was going to be unable to pay us, we debited bad debts expense and then we credited the accounts receivable. And the problem with the direct write-off method, like what we talked about in the prior lecture video, is that it violates the matching principle. Now that's not a severe problem as long as the bad debts expense is a small dollar amount. It's immaterial. But what if it's material? Then we need to use the allowance method. Now the allowance method satisfies the matching principle. I'll say that again. The allowance method satisfies the matching principle. How does it do that if it's still possible that you make the sale in year one, but you find out that the customer can't pay you in year two? How do you handle that? Well, the way that the allowance method handles that situation is at the end of year one, at the end of the year, we make an estimate of how much bad debts expense we think we're going to have. So basically, we estimate how much in terms of dollars, right, do we think customers are not going to pay us, right? So we make an estimate of our bad debts expense. And remember, our bad debts expense is when customers can't pay us. So at the end of the year, we say, well, we think maybe 4% of our sales will never collect. Or maybe 2% of our outstanding accounts receivable we're not going to collect. And so that's our estimate. And so at the end of the accounting period, we do an adjusting journal entry. We debit bad debts expense for that estimate. And then we credit a contra asset account called the allowance for doubtful accounts. All right. So what we will do is at the end of the accounting period, we'll make an estimate of bad debts expense, perhaps based upon percent of credit sales or percent of outstanding accounts receivable. We debit bad debts expense, and rather than crediting accounts receivable like we did with the direct write-off method, we credit a contra asset account called the allowance for doubtful accounts. Now on the balance sheet, the way it's shown is we have our accounts receivable minus our allowance for doubtful accounts gives us our net accounts receivable. Okay? So I've kind of given you a really high overview of the allowance method, and what we're going to do now is do some example problems. Okay? Before I do that, I did want to touch on this bullet right over here. It says at the end of the period, though, the customer is going to estimate how much accounts receivable will not be collected. That could be based on past collection history, maybe percent of credit sales or percent of outstanding accounts receivable. Now, here's the key thing that I wanted to make sure you understand that. We said we don't know specifically who will not pay us. We don't know that J. Kent is not going to pay us. Because if we do that, we would not extend credit to J. Kent. As we talked about, J. Kent was in our last lecture video. So we wouldn't extend credit to that person or to that company if we knew that that they were going to pay us. So we don't know specifically who. We just have to make our estimate based upon prior credit sales or based upon outstanding accounts receivable. Okay? So let's look at our first example right over here, where we say TechCom had credit sales of $300,000 during the first year of operations, and at the end of the first year, $20,000 of credit sales remain uncollected. Based upon the experience of similar businesses, right, TechCom thinks, and I'm going on to the next page here. By the way, this lecture video starts on page 182, so this first page of the lecture video is on page 182. And now I'm on page 183. So TechCom thinks that $1,500 of its accounts receivable is going to be uncollectible. So I'm waiting for it. Sorry, sometimes this has just the document camera has to focus. There we go. Sorry about that. So TechCom thinks that $1,500 of its accounts receivable will be uncollectible. They're never going to get that. So what is the journal entry? The journal entry to record this, okay, and this would be done on 12/31 at the end of the accounting period, our adjusting journal entry. we will debit bad debts expense for $1,500, and then we will credit our allowance for doubtful accounts for $1,500. So we debit bad debts expense for $1,500, credit the allowance for doubtful accounts for $1,500. This allowance is a contra asset account, which means the normal balance of this is a credit, right? Because the normal balance of an asset is a debit, contra is opposite, so the normal balance is a credit. This is very similar conceptually to our accumulated depreciation. Remember when we talked about depreciation expense, and when we talked about the journal entry to recognize depreciation, we debited depreciation expense and we credited accumulated depreciation. And what we said was that accumulated depreciation is a contra asset on the balance sheet. And we took the original asset cost minus accumulated depreciation to give us the book value of that asset. Similar here. And we can see that down here in this figure, which shows us the balance sheet presentation of our allowance for doubtful accounts. We have our original accounts receivable less our allowance for doubtful accounts of $1,500 gives us net accounts receivable right there of $18,500. That is our net accounts receivable. This is the number, $18,500, that comes into calculating total assets. So when we add up all of our assets to get to total assets, we take the $18,500. That's the number that comes into calculating total assets. Bad debts expense, right up here, is another, as I was saying in the prior lecture video, is an expense on the income statement. It's classified as a selling and administrative expense on the income statement. And this is our this is also known as our estimated realizable value. Sometimes you'll see it as accounts receivable net, okay? And so it's basically our accounts receivable minus our allowance for doubtful accounts gives us the net accounts receivable right there, okay? Now let's talk about the situation where we write off the bad debt. So remember that what we just did right there was based upon an estimate. That's our estimate, okay? That's not when we find out that a customer is not going to pay us. When we find out that a customer is not going to pay us, that's going to be this journal entry, writing off that bad debt, okay? Writing off the accounts receivable, okay? So let's look at that journal entry. So we see over here, let's say that TechCom decides that J. Kent's 520 account is uncollectible. And I'll come down here and write out the journal entry. And we can say that's going to be on our 123. Let's say that's on January 23rd. We recognize bad debts expense on December 31st of the prior year. Year 1, that was the journal entry we just did. This is the journal entry in year 2 to recognize that J. Kent is not going to pay us. So now what we do is we debit our allowance for doubtful accounts. We don't debit bad debts expense. Why don't we debit bad debts expense? Because we debited at the end of December year 1 based upon our estimate. That's when we debited bad debts expense. Now we're not going to debit bad debts expense. We debited in the prior year to match that bad debts expense in the same period as we made the sale to J. Kent. That's when we debited the bad debts expense, which is based upon an estimate. Now we come forward on the 23rd of the next year, year 2, and we find out J. Kent can't pay us. So we don't debit bad debts expense again. We debit the allowance for doubtful accounts. And by debiting the allowance for doubtful accounts, we reduce the balance in the allowance for doubtful accounts, because the normal balance of an allowance for doubtful accounts is a credit, and by debiting it, I decrease it. So I debit the allowance for 520, and then I credit accounts receivable, AR, for 520. And that's my journal entry right there. Okay? So I don't debit bad debts expense here when I find out that they're not going to pay us, because I debited bad debts expense at the end of the first accounting period, which is when we made the sale. Okay. Then when we come forward to the next accounting period, year 2, we find out that J. Kent can't pay us. We just decrease the allowance and then we decrease the accounts receivable. And that's what we see at the top of this page right over here. I kept it right over here in this figure. You can see debit to the allowance, credit to the accounts receivable, 520. Now, the important thing is to understand is that write-off does not affect the realizable value, the net accounts receivable. It doesn't affect that. If we look at this figure right over here, we can see we have accounts receivable less our allowance for doubtful accounts gives us our estimated realizable accounts receivable. We have our accounts receivable right there, less our allowance gives us $18,500. That's before the write-off. After the write-off, look, I credited accounts receivable right up here for $520. That means accounts receivable is $520 less. It's $19,480. And then I debited my allowance for $520. That means the allowance is $520 less. Now it's $980. So I take my $19,480 minus my $980, and then my realizable value is the same, $18,500. Okay? Let's talk about the situation where we recover the bad debt. So similar to the direct write-off method, when we recover bad debt, we have to do 2 journal entries. The first one is to reinstate the accounts receivable. Okay? Reinstate the accounts receivable. So it's basically a reversal of this journal entry. So we'll debit the receivable, credit the allowance. And then the second one is to recognize that we got paid. We debit cash and we credit the accounts receivable. So let's look at page 186 right over here, where we look at this example problem. So it says, if on March 11th, Kent pays his account in full, his account that was previously written off. Let's look at the journal entry. We come over here on 311. So we will then debit accounts receivable, 520, and then we will credit the allowance. And I'm just going to write allowance, but the whole name is allowance for doubtful accounts for 520. That will be the first journal entry. And then the second journal entry that we do here is a debit to cash for 520. And then we will then credit accounts receivable for 520. So 2 journal entries to recognize that we are recovering a bad debt. Okay? And that, remember, the recovery of the bad debt is that situation when we wrote off the bad debt, we thought J. Kent would never pay us, and now in this situation we say, well, it appears that J. Kent can't pay us. So this first journal entry, just like what we talked about with the direct write-off, is to reinstate the accounts receivable, and then the second journal entry is to recognize that J. Kent paid us. All right? So I'm going to end this lecture video now, and then in the next lecture video we will talk about the methods for estimating bad debts. Because in this problem, right, the first one that we said they had $1,500 of accounts receivable they thought that they weren't going to collect. Well, how did we get to that $1,500? That's what we want to talk about next, okay? Thanks so much.